Well, as Tim mentioned, we do have an in-studio guest. Chris Swift joins us now. He's our regular contributor with Swift Trading Incorporated, based in Nashville. Happy Monday.
Thank you. Same to you, sir.
So kind of a mixed start here to the week.
A little bit.
We had January deliveries posted this morning, and we can take a look at these on the screen here for everybody. Just to get you up to date on what the deliveries were, we had the soy meal coming in at 132 contracts. That was down 160 from Friday. Soy oil up to 417 contracts. That was up 63. The soybean deliveries dropped 260 contracts down to 55. The rice went down 1 to 2 contracts. The last trading day is tomorrow, correct?
That's what we discussed a little bit earlier,
so these have to all come down to zero pretty quickly.
Or they will be delivered. You'll get a warehouse receipt for them.
Are you surprised to see them that high yet?
No, not really. No? There just hadn't been a lot of movement or delivery anyway. So, yeah, they'll probably hold it right to the very last day there and take them off, be my guess.
We also had an overnight sale announced of corn to South Korea, but it was optional origin, so we don't really know if we'll get all or any of that, right?
Right.
If that's the case. All right. So corn market kind of quiet here this morning as we open things up, but it's kind of firming up a little. Look at that March contract. Now we're 2.5 higher at 388 1/4. It's leading the way. The deferred contract's only fractionally higher there, so there is that. If you look at the soybean trade, though, quite a bit of pressure this morning. You have your March contract now down 4 3/4 at 941 1/4. Why are the soybeans so weak in the knees today?
I think the WASDE report didn't show anything favorable towards the bean market, and we've got the January 15th tariff signing deal coming up, and I think everybody's a little bit skeptical about that, and they want to actually see the ink on the paper and see how many bushels that China is really going to be buying from us before they go bid for inventory.
So there's one school of thought that, you know, if they say they're going to buy $40 to $50 billion of U.S. ag products, that is way more, like almost double what their biggest buy used to be, right, on an annual basis. On the other hand, we don't know what that allotment would be, even if they did do that.
Well, and that's very true. And, of course, we thought they would buy hogs, too. So we're not real sure what they will actually end up doing. And although I know the trade agreement will be great to be able to get some things solidified in there where we can start transacting business a little bit easier, but how and when they buy will be big questions everybody will want answered.
A little bit of pressure on the wheat. Let's take a look at our wheat prices right now. We start with Chicago wheat, and in that March contract today, we are currently trading 1 3/4 lower at 562 3/4. On the Kansas City market, kind of similar action. It's like they're kind of keeping par with each other. March now 1 3/4 lower in KC wheat. It's trading at 493. The Minneapolis wheat also under a little bit of pressure today. Here you have that March contract on the Minneapolis wheat showing a trade that's roughly about 2 1/4 lower. Here it's 1 3/4 lower at 556 1/2, so it's kind of hanging around that 2 cent lower mark. The acreage on the wheat, though, now it's way more than the 100-year low, right?
Yes, yeah, I think it was under 54 million acres, if I'm not badly mistaken. I don't remember the exact number, but yes, it was very low. And then, of course, we've had pretty poor weather for it. We got no snowfall stand on it, but you had no blistering cold weather yet either to it. But it's from what I've understood, the stands that have come up are just not 100%.
So a lot remains to be seen on that. Everybody had talked for a couple of years about the burdensome supply, and now all of a sudden record low acreage maybe, and so we'll have to deal with that. We'll come back here in a moment. We'll talk more with Chris here about our livestock trade. We had a lower open. We'll see if it's still that way or not when we come back. We're joined by Chris Swift of Swift Trading Incorporated in Nashville. Now we'll take a look at our livestock trade. We started out weaker on the day, and we are still weaker on the day, led by the nearby contract on live cattle. We have February down 75. Chris, we're at 126.67. We're within a dime of our low of the day as it stands right now. April down 60, and the deferred contracts get progressively less to the downside as you go further out. If you look at our feeder cattle market today, we started out, we had several contracts over $1 lower. Now things have moderated somewhat. We're still lower, but not quite as severe here. January down 97, the March down 85 now at 146.60. So it has come back a little bit from the earlier trade. On the lean hogs, we now have the nearby February trading $1.20 lower at 66.05. That's right at the low of the day. April down 95 at 73.17. So kind of a similar action there. Not a lot to write home about today when it comes to the livestock trade here from a bullish perspective. But what, is this normal for early in the week? What do you think?
Probably so. I got to spend some time with some cattlemen this weekend at the Tennessee Cattlemen's Association convention. A couple of things that I took away from that is there's a little bit of margin coming back in some of the sectors. The cow-calf sector, probably the least of gains back, but through the backgrounding and some of the feed yards, we've seen some profits come back into those two sectors. Some elevated respiratory problems, because what Tim showed, the elevated moisture that we've got, real dramatic changes in temperature from really cold to really hot, and animals just have a tendency, just like we do, to get sick during those time frames. So I don't see anything out there really to anticipate one way or the other. We know that we've got plenty of cattle on feed. We got about 3% more cattle on feed than we did this time last year. Our carcass weights have increased a little bit. We're marketing just a fewer less head every single month for the last 3 or 4 months. So things just kind of stabilized. We had massive amounts of price fluctuation and disruptions of production through the latter part of summer and early fall. Now we're just kind of bringing those back into line again, and seemingly like we've smoothed things out for a while.
And so far in the southern half of the plains, it hasn't been an extreme winter at all.
Oh, no, it's very nice. Very dry, as a matter of fact. Once you get past probably Amarillo, it's been really dry down there. So
yeah. Real quickly, we only have 30 seconds left. Hog weights.
Hogs.
Still a problem?
Still a problem. Still production a problem. And no increases in lean hog carcass prices, so therefore the index has not risen. If the index doesn't rise, the futures will have a hard time spreading against that.
And are they getting oversold? Would you call them oversold or not?
Probably not, because the index hadn't moved much of anything, and the futures still have a good $8, $9 to go lower before they would even equal the basis.
Is that right? Okay.
Yeah.
All right. Well, thanks for pointing that
Sure,
out.
absolutely.
You're a good student of the markets and a good teacher explaining everything. So thank you for stopping by. Chris Swift of Swift Trading Incorporated right here in Nashville. Janet, back to you.
All right. As always, thank you, gentlemen, very much.